Hey, what's up, everybody? Just hopping on here to make a video sharing some content that I have found that has been helpful for building out our portfolio and establishing our children's financial freedom. So, I'm not a gatekeeper. If I find good, solid content that has been beneficial for us in our financial journey, I want to share that with you. And again, the goal here is to not only build wealth for ourselves, but we're establishing our kids' portfolio. And content like this can be super helpful, especially when we don't know what the market's going to do or the market is doing just odd moves. It's great to just have a good, solid system in place and have a low risk uh, approach to building your wealth. So we're not doing this right now because the market is on a rip and I'm playing it just a little bit aggressive for the time being. But when I get back into school, I'll go ahead and just move our portfolio or move our assets around um, to be on a little bit of a lower risk side. But let's watch this. I'll chime in and just maybe talk about how his content has affected our approach and portfolio. So let's get right into it.
If tomorrow I had to sell every investment I own and I could only keep two ETFs for the next 30 years, these are the only ones I'd trust with my entire financial future. No stock picking, no sector bets, no constant adjustments. Just two investments I'd be comfortable holding through every market cycle. So today I'm going to show you the two categories I'd build around, the specific ETFs that I would choose, and a few strong alternatives in case your investing style is just a little bit different than mine. Because
Okay, so real quick, his point here is just to play it safe. It's kind of a set it and forget it kind of approach to where you're just consistently feeding the a system and your wealth is growing no matter what the market is doing. Hey, if you've got the 9 to 5 rundown, you wake up, go to your job, come home, uh, do your recreational activities, spend time with the family, rinse and repeat, Monday through Friday kind of thing. That's great. This is a great approach. That's not our situation right now. So I am managing our portfolio a little bit more aggressively. And once I start school, I will definitely just rebalance everything in our portfolio so I can take this approach. But there's different strategies in the way you manage your portfolio. Not everyone has the time to check um, their portfolio multiple times a day. This is a really good approach to just play it safe, kind of set it and forget it, no matter what the market is doing. So, um, if that's you, then take heed to this approach.
Because building wealth isn't about finding the perfect fund, it's about creating a simple system you can stick with for
Yep,
decades. Most portfolios fail for
that's
one
it.
simple reason: they're too complicated. Too many funds, too many opinions, and too many changes. The more decisions you have to make, the more likely you are to second guess yourself when markets get rough. If I were starting over and keeping things simple, I'd focus on just two parts of a portfolio: one for growth and one for income and stability. Let's start with the growth side. Hi, I'm Greg Hardy, and welcome back to the channel, and thank you for being here. We cover all things personal finance, investing, and building a secure financial future. So if you're serious about taking control of your money and also learning something new every week, make sure to subscribe to the channel and like this video. It really helps the channel out and gets this information to more people who need it. Thank you.
I
This part
recommend
of the
it. Please
portfolio has one
subscribe.
clear purpose: long-term growth. It's where your wealth is actually built over time. This is the portion that benefits the most from compounding, where a small contribution today can turn into something meaningful years from now. It won't always be smooth, and there will be periods where the market moves sideways or even down, but over long stretches, this is the part of the portfolio that does the heavy lifting for you. If I could choose only one growth fund, SCHG would be my default, but I'll also show you a couple strong alternatives depending on your style. SCHG focuses on large established companies that are leading innovation, gaining market share, and driving a big portion of the economy forward. SCHG has a strong long-term track record, very low cost, and broad exposure to many of the companies that have powered market growth over the past decade. Another reason that I like SCHG is balance. It gives you strong growth potential without becoming overly concentrated in just a handful of stocks. You're still getting heavy exposure to major market leaders, but the risk is spread across a wider group of companies. For most long-term investors who want growth without taking extreme swings, this is a very solid core choice. Now,
Yeah, so there's two kind of strategies when you're investing. I should say three, which would be the hybrid. But the first is where you're just simply focusing on companies that are growing and are profitable, and they're giving a return in how they're valued. That's one approach where you're just focusing on companies that are doing this. The second approach is to invest in the overall market and how the market is growing, and you get a piece of that back. The downside to that is you don't get as much of a return as you would if you were to focus on a specific company. You get a smaller return, which would take longer. Whereas if you focused on particular companies, that return is exponential and a lot faster. And then the third approach is, and this is just what I found in the last 6 months. The third approach is to do like kind of a hybrid, a blend of both. So um, it's how much knowledge do you have? How much wisdom can you implement uh, when it comes to managing your portfolio? And I'm always learning, so um, I think we're at a spot where we can be just a little riskier right now, especially with the market ripping how it is. But believe it that there will be a correction at some point. Your portfolio will reflect your strategy. So take it for what it is. It's your risk tolerance and the research that you do. So those are the approaches that I know when it comes to managing your portfolio.
Now, if you're willing to accept a little more volatility in exchange for some higher potential upside, QQQM is a strong alternative. It tracks the NASDAQ 100, which means it's heavier exposure to tech, innovation, and high growth sectors. When the growth stocks are leading the market, funds like this can perform extremely well. The trade off is, though, that when tech struggles, the swings tend to be larger. A third option is SPMO, which takes a different approach by focusing on momentum. Instead of holding companies based on size or sector, it leans into stocks that are already showing strong price trends. In strong markets, this strategy can outperform because it concentrates on what's working right now. But momentum strategies can also be more cyclical, meaning performance may come in stronger bursts followed by quieter periods. A simple way to think about these choices is this. SCHG is balanced growth. QQQM is more aggressive growth, and SPMO is a more tactical, trend-focused approach. But no matter which one fits your style, the role stays the same. This is your long-term growth piece, the part of the portfolio designed to compound, expand, and steadily build your wealth over time. The second part of the portfolio has a completely different purpose. This isn't about chasing the highest returns. Its role is to provide stability, consistent income, and something that keeps working for you even when markets are feeling uncertain. While the growth side focuses on expanding your wealth, this part is designed to make the overall ride smoother and easier to stick with over time. SCHD would be my default choice here, but I'll also give you a couple alternatives if your goals are different. SHD focuses on high-quality companies with strong balance sheets, reliable cash flow, and a long history of paying and also growing dividends. These are established businesses that tend to be more stable than high-growth companies. SCHD has also built a strong reputation for steady dividend growth, low costs, and lower volatility compared to the broader market. One of the biggest advantages of a fund like SCHD is how it helps investors behave during difficult markets. When prices are falling, you're still receiving income. That steady cash flow changes the experience. Instead of just watching your balance move up and down, you see your investments continuing to produce something, and that makes it much easier to stay invested when emotions would otherwise take over. If you're looking for something similar but with a little bit more growth built in, VIG is a strong alternative. It focuses on companies that have consistently increased their dividends over time. The yield is typically a little bit lower than SCHD, but the underlying companies often have stronger earnings growth. That creates a nice balance between income today and appreciation over the long run. For investors whose primary goal is income, JEBQ offers a different approach. It uses an option strategy to generate higher cash flow, which results in higher yield than traditional dividend funds. The trade-off is that the upside tends to be more limited during strong bull markets. This type of fund is generally better suited for investors who want consistent income now or who are closer to retirement. A simple way to think about these choices is this. SCHD is a core dividend strategy, VIG focuses on dividend growth, and JEBQ is built for higher income. No matter which one you choose, the role stays the same.
So that's where we're at right now, is we're focusing on dividend producing ETFs that lend itself to consistent income, and we're aiming for that higher income right now. And then when I start school, I'll rebalance our portfolio. But this is a really good setup right here, and it's if you need that cash flow, then boom, this is it right here. We have all of these in our portfolio. I'm sorry, except for JEPQ. I've replaced those with a couple of different ones that are just higher yield and um, more dividend um, outcome. We're getting more dividends. Sorry, that's we're getting more dividends out of different ETFs than just JEPQ. So good setup right here. All for it.
This part of the portfolio is there to provide stability, steady cash flow, and the confidence to stay invested through every market cycle. Here's the real advantage of this approach. You're not trying to predict what the market will do next. Different types of investments lead at different times. Growth stocks tend to perform best when the economy is expanding and interest rates are low. But when markets become volatile, interest rates rise, or investors become more cautious, dividend and income-focused companies often hold up better. Instead of trying to guess which environment is coming next, you're simply owning both sides. One part of your portfolio is positioned for long-term growth, while the other is built for stability and income. And because growth funds and dividend funds typically hold very different types of companies, there's minimal overlap between them, giving you broader diversification instead of doubling up on the same stocks. But the biggest benefit isn't performance, it's behavior. This kind of simple structure makes it much easier to stay invested when conditions change. And over the long run, staying invested through multiple market cycles matters far more than trying to predict which strategy is going to win next. The good news is that you don't need anything complicated to put this together. The structure stays the same, you just adjust the percentages based on where you are in life. Earlier in your career, when time's on your side, you might lean heavier towards growth, something like 70 to 80% in your growth fund and 20 to 30% in your dividend and stability fund. As you move into your mid-career years, the goal usually shifts towards balance. This is where a 50-50 approach can make a lot of sense. You're still getting meaningful long-term growth, but the income and stability side starts playing a bigger role in smoothing out market swings and reducing your overall risk. As you get closer to retirement, the focus typically moves towards protecting what you've built and generating reliable income. At that stage, you might shift to something like 30 to 40% growth and 60 to 70% in dividend and stability. Same structure, same system. The only thing that changes over time is the percentage, not the strategy. Here's what matters most about this approach. The real strength of this strategy isn't the specific ETFs, it's the simplicity behind it. When your portfolio is built around just a few clear pieces with defined roles, you remove a lot of the decisions that tend to derail investors over time. You're not constantly wondering what to add, what to remove, or whether you're missing out on something better. Fewer funds means fewer changes, and fewer changes means less second guessing when markets get uncomfortable. You're not chasing the latest trend, you're not reacting to every headline or feeling the need to adjust your strategy every time one area of the market goes through a rough period. Instead, you have a structure that's designed to work through different market environments, both the good years and the difficult ones. And that's where long-term success really comes from. Not from finding the perfect investment or timing the market just right, but from staying invested long enough for compounding to do its work. Because over decades, consistency beats perfection. And the investors who build the most wealth are usually the ones who simply stick with a sound plan and give it time to work. Now, if someone told me I couldn't check the market again for the next 30 years, I'd still be completely comfortable owning a simple portfolio like this, because the goal isn't to react to the market, it's to stay invested long enough for compounding to do the job. If you step back and think about it, most successful investors don't win because they found something complicated or clever. They win because they made a few good decisions early, kept their strategy simple, and gave it time to work. 30 years from now, what will matter most isn't which fund slightly outperformed the other. It's whether you stayed consistent, kept investing, and avoided the mistakes that come from constantly changing direction. Simple strategies like this aren't exciting, but over time, boring and consistent is exactly what builds real wealth. Now, I'm curious how you're thinking about this for your own situation. If you had to limit your portfolio to just 2 ETFs, which ones would you choose? And would you lean more towards growth or income right now? Let me know in the comments. I read them all, and those real-world perspectives help everyone learn from each other. If you found this video eye-opening, don't keep it to yourself. Share it with someone who you think needs to hear it. And if you want more practical, no-nonsense advice on building wealth and securing your financial future, then check out this video here. And also, please make sure to subscribe.
Yeah. So there you go. That's a very simple um approach to take. Um if you're doing this in your 20s, you're guaranteed to be a millionaire by the time you're ready to retire. Um we, however, are I don't have, you know, 40, 30 years to work. I would like to be financially independent and be able to retire early. So we are managing our portfolio just a little more aggressively right now. But there will be a season where you can just orient your portfolio where it is a setup like this. And you don't have to worry about what the market's doing. And you don't have to constantly wonder if you're missing out on something. So, really good content. I hope you guys take something away from it. But yeah, we'll do more of these, and this is good. I recommend a setup like this if you're early on. So, all right, guys. Until the next one, have a good one.